Let's go. Good morning, folks. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Wednesday, the 28th of December. I'm your host, JD Durkin. Opening bell rung moments ago. Very special guests here on the floor by executives and guests of Syracuse University, the University of Minnesota, and of course, the New York Yankees in celebration of the Bad Boy Mowers Pinstripe Bowl. That's a football game tomorrow played at Yankee Stadium, sponsored by Bad Boy Mowers. Good luck to everyone who will be playing. Taking a look now at how major averages are kicking off on the Wednesday here. Stocks are trading fractionally in the green. Is that right? That was right a minute ago. Yeah, that's the case still. This after stocks closed mostly lower on Tuesday as hopes of a year-end rally begin to fade. It was a strange day because the Dow, if I'm not mistaken, Chris will correct me if I'm wrong, the Dow finished up fractionally, not the story, however, for the S&P and the NASDAQ, but the Dow had some big names like Verizon, Chevron, helping move action into positive territory for that particular index. Investors still a bit skittish heading into the new year as recession fears continue to mount, and all signs are we're still looking for Santa Claus. Taking a look at what is on tap for this morning's broadcast, we will talk markets as investors hold on to that last glimmer of hope that stocks could reverse their 2022 slide. Not a lot of time left for that reverse to happen. Plus, we'll tell you what to consider when shopping around for new companies to invest in the new year. And finally, Southwest's stock is continuing its descent as its turbulent week continues. What a disaster. So should investors be concerned? Should investors be more concerned if you're an investor in Southwest, or should you be more concerned if you have a ticket for a Southwest flight? We'll break all that down and so much more. For more on those stories and so much more, we now welcome back our Action Alerts Plus co-portfolio manager, Mr. Chris Versace. Chris, I hope you don't have any tickets currently purchased for a Southwest flight, but I do want to ask you about the markets here. It's top of mind. Another down day for the S&P and the NASDAQ. How quickly are hopes dashing for a St. Nick rally? Dashing there, not a reindeer pun, but I guess it could be.
It could be. It could be. I always appreciate how quick on your feet you are with this kind of stuff, JD. But in terms of the Santa Claus rally, look, we won't really know until 2 days into next week. Remember, it's the 7-day period, so we have to look at it in total. But so far, I don't see any sign of reindeers on the horizon. Do you?
I mean, I certainly do not. But to be fair, I have the easy job here. I just host the show. I ask you the questions, and you get to weigh in here. So yeah, so we've got just in terms of the calendar. So we've got today is Wednesday. We got tomorrow, Friday we're closed, and then we've got Tuesday Monday and Wednesday of next week. Oh, Friday we're open, Monday we're closed. Pardon me, and then Tuesday, Wednesday, right?
So it'll be. But here's the thing, and I think this is key about this week in general. There aren't a lot of earnings. There's not a lot of economic data. It is typically one of, if not the quietest weeks during the year. Typically, that means trading volume is very low. We can see perhaps some outside swings in individual stocks. But by and large, a lot of people are resting and recharging for what's going to happen as we come back to work, so to speak, next week. A lot of economic data is going to hit us. We're going to be on watch for negative earnings pre-announcements. And in fact, while I was getting ready to talk to you, there's a report out on DigiTimes that Taiwan Semiconductor could see a 15% drop in its first quarter revenue. And I think we're going to hear a lot more stories about that as people revisit the notion of what does a slowing economy really mean as we start off the year? And if it dips into a recession, what does that mean for the data? What does that mean for earnings? So I think people are, again, kind of resting and recharging this week. Great time to build your shopping list.
One thing we did not mention in yesterday's show was investors intentionally selling at a loss in order to help offset their capital gains or their ordinary income. 'Tis the season for tax loss harvesting. It's also the season for chestnuts roasting on open fire. But I'm a bigger fan of the idea of tax loss harvesting. Are we seeing evidence that so far this week, or is it still a bit too early to tell?
It's interesting you bring that up. I actually wrote a note to AAP members where we added to one position, and it's in the EV space, and it was down, considerable amount since September. But then again, the whole EV space has been hit. But if you think about the outlook for that space, very positive in my view, longer term if you're kind of outside Tesla. But I do think that you're spot on. We are seeing a lot of that happen this year. People kind of throwing in the towel, getting ready to reset for next year. Have to be careful to avoid the wash rule as they do that. But I think you're 100% right. There is without a doubt tax loss harvesting this year, people getting preparing to reset, if you will, for 2023, because that's the magical thing about measuring the stock market. When we close the books on Friday, the clocks get reset back to 0.0% and we kick off again.
Is there anything that is top of mind for you that you would want an investor to keep in mind here in these next 48 hours as we finally turn the page on the year that was 2022?
It would just be, take stock of, what happened in this past year, think about what lies ahead, and start to think about the kinds of companies that you want to own as an investor. Because it's going to be a very different dynamic, especially if we head into a recession. The characteristics that you're going to want to be thinking about for the businesses that you're investing in or buying shares in, very, very different than, say, coming out of the pandemic or the last several years. So you really got to adjust your mindset and think about those qualities, those factors. And it also probably means that you're going to have to think about different ways of valuing companies because, are we going to see, 10%, 15%, EPS growth? Probably not. So you've got to start to rely on other metrics, other tools to help navigate the road ahead.
What are some of the biggest risks facing markets on that road ahead in 2023 you think should be top of mind for someone trying to figure out what is happening and where are we going? Where are we going is really the question.
Yeah, look, all indications are that we're going to have there's somewhere between a dramatically slower economy ahead or a recession. And when you and I spoke a couple of weeks ago, I said the big question to me when we have a recession is how long, how deep? And there are reasons to think that, it could be a very mild recession. There are people arguing out there that, well, we may not actually have a recession technically, but it may feel like it. And I even believe that those are some of the words that Fed Chair Powell used when he spoke last time. So the idea is in that environment, how do you thrive? And there are more defensive names, inelastic business models that you can do and invest in. So that's the preparation, I think, that the smart investors are doing this past week. I don't mean to pat ourselves on the back over at AAP, but we've been preparing for this for the last couple of months. So, when you look at some of the holdings we have in the portfolio, they tend to be more consumable products in nature, like a McCormick or a PepsiCo. They tend to be companies that are what I like to call dividend dynamos. What I mean by that is these companies have a long track record of increasing their dividends no matter what the economic environment. You touched on Verizon earlier. We own that in the portfolio. That's sporting something close to a 7% dividend. And back when I was teaching undergraduate and graduate finance classes, I would poll my students. And I'll ask this question to you now, JD. If you had to give up a meal or two a week to ensure that you could pay your mobile phone bill, would you do it? Or would you let the mobile phone subscription lapse?
I'm not a big fan of food in general. I'm paying that phone bill, all right? That's my answer. That maybe not the same answer for a lot of people. And I don't know if that's the answer you're looking for either. I'm just speaking from truth.
No. It's so when I would poll my students, invariably, they would put their hands up and say, I need my mobile phone. And if you think about the reason for that, it's how we do so many things today. How we talk to people, which used to be by voice, but increasingly text or even video. How we pay our bills, social media, consume content, all that stuff. So, the notion to me that Verizon is sitting there with a 7% dividend yield is simply fantastic because people, at the margin are not going to cancel their mobile phone service because it's how they stay connected.
I do want to get your set because we've had many recession headlines. We will continue to have many recession headlines. Can we just take a quick step back and help remind our viewers what a recession actually means? We talk about unemployment. There may be wage cuts. Obviously, people may lose their jobs, which means their insurance. But if I had to ask you, what does a recession mean for the average person who maybe kind of forgets what it's like to actually live one? What are the things that are top of mind for someone as they see these headlines, Chris? We're heading into a new year and they're saying, oh shoot, I should probably be better prepared, especially in terms of paying off debt or things like that. What do you tell that person?
So let's start with technically speaking, what is a recession? It's two back-to-back quarters of negative GDP growth. Okay, fine, great. But to your point, what does that mean for the individual who has to live through this? It probably means that some of the things that we've started to see in recent months are going to continue, most likely accelerate. That could be job layoffs. That'll be a very big one. We'll see companies cutting back in discretionary items, companies slowing their capital spending, perhaps retrenching their physical footprint, especially today in the era of the hybrid work environment. So we could see that continue as well. Now, from the consumer perspective, if you're hearing about layoffs, if you're maybe not seeing the bonuses that you might think, or you're not even sure if you're going to get a raise, you might have been taking out more debt. At least that's what the data shows, and you're going to be saddled with higher interest rates. It's a reason to think that consumers are going to, cut back their discretionary spending, something that we've started to see of late, and we're likely to see more of that in the coming months ahead. So that means, by and large, a lot of the economic drivers are going to, dial back, continue to slow. And the issue with the recession is it tends to be somewhat of a self-fulfilling prophecy in that, oh my goodness, we're in a recession. I better save where I can. I better slow my spending. Therefore, the overall spending, whether it's corporate or individual consumer, continues to slow further. But the tricky thing with recessions are we don't necessarily know that we're out of it, or even sometimes in one, until we're out of it. So it can be a very tricky environment for folks. For investors, it tends to be a shoot first, ask questions later type of an environment where people tend to assume the worst is happening. The great thing about that, from an investor's perspective, we've been through these before. Companies have been around. We've been able to identify successful business models that work as an investor. But we also have that history that says, look, the last two recessions we had, where did a stock bottom? How deep did its earnings get cut? How far did its revenues fall? So we have some benchmarks that we can start to utilize and say, okay, this is where things might be bottoming out. This might be where things are kind of overdone. And I think that's the homework that we as investors need to start thinking about as we head into 2023.
Yeah, and of course, then we've got the National Bureau of Economic Research, the Dating Committee, which I think people would be like, the what? And that's largely the group of economists, university professors. And you're right, they look back at data from the last year. And to further underscore your point, they said in December of 2008 that we actually hit a recession a full year before, December 2007. So they're looking at data from the previous year. And it wasn't until September of 2010 when they said, oh yeah, we actually got out of a recession all the way back in June of 2009. So it takes some while. So to your point, this whole time we could have been sitting here having these conversations of will we, won't we be in a recession, and we may very much already be one. That's a bit of a separate definition than the two consecutive quarters of negative GDP. But that's an important point to underscore. I do want to ask you about potential buying opportunities. People will say buy the dip. We just don't know where the dip is going or if we're there. I mean, give me your sense on if the market has bottomed out, or we were talking before we came on air. Are we going to see, an index like the S&P continue to fall much below 3,800? Will the Dow Jones fall lower than 30,000 at some point in the next few months? What's your sense on where we might be heading to help people strategically place themselves for buying opportunities?
So it's always hard to give a precise number, right? But directionally speaking, I do think there's far more risk in the market. We talked a little bit about this yesterday, but the gist of it is this. When you look at consensus earnings for the S&P 500, they're still calling for 4 or 5% growth year over year. Typically, the forward year, so in this case 2023, gets reset hard for the first real time as we kick off the December quarter earnings season. So in the next 3-4 weeks, we should start to see some fine tuning, if you will, for that figure for 2023. But we are already starting to see some folks at the margin come out, and what they're doing is they're not raising their 2023 expectations. Think about the conversation that we've been having, the data that's been coming out. They're turning around and they're actually cutting expectations, some as low as $195, and for context, that compares to $220 for 2022. So when you look back, and again, you use that history, where was the market multiple the last time the Fed funds rate was approaching 5%? So between 4.5% and 5%, it's around 17 times. 17 times, $210 if you want to use that, or $220 if you want to be generous, saying S&P 500 earnings are flat year over year. That's a number that is either near where we are today, or if you go 210, modest cut, it's going to be lower. So I do think there's some downside risk, but that's not really going to emerge until, again, that December quarter earnings season starts. So my word to the people watching, and certainly to the members who subscribe to Action Alerts Plus, is be cautious. We've had inverse ETFs in the AAP portfolio, and we fully intend to hold them as we move into the December quarter earnings season.
Now, a lot of those investors are gearing up for the new year. Many are using this time to kind of shop around for new companies to invest in, especially anyone that is intentionally taking those losses late in the year and they're harvesting, and they may look to rebuy some of those names with a fresh slate come January. What are some of the biggest questions, Chris, you think important for investors to ask when considering any of these new investment opportunities, whether or not they've previously had positions in those companies or not?
Well, I mean, the first and foremost thing is, what does the company do, right? So we're heading into a very different time. Has that business been able to thrive in the past? So is it defensive in nature, right? Is it consumables? I mentioned McCormick's and PepsiCo, right? Those are very consumable products, right? We have to eat every day, or most people do, unless, of course, JD, you remind me that they're looking to pay their mobile phone bill. But people have to consume those products. So we know that they tend to be defensible. But other ones out there, is it inelastic? Meaning that no matter what the pricing is, people will continue to consume that. Great example of that is, paper products, Procter & Gamble and other players in there as well. The other question I think you have to start asking yourself is, what were the valuation parameters the last recession or the last two recessions? You can kind of build your framework of where you really want to be backing up the truck and buying these names if the market pulls back. It also means, though, that because we're going to have some questions around earnings, will they fall? How much will they fall? How fast will they fall? You have to start looking at other valuation metrics to really zero in on where that potential bottom is and where that buying opportunity is compelling. So those are some of the things I think folks start to need to really dig into. I would say, you should be using this week to do it, but there's no time like the present to start.
No time like the present to start. I like that. We've also seen a gradual easing of COVID restrictions in China, this following a multi-year effort of the zero COVID policy. It's begun to change in recent days, something we talked about briefly yesterday. How might that impact markets as we kick off 2023? And are you confident that kind of scaling back from the COVID policies is here to stay? Is there a chance that China may do this for a few weeks and then say, well, we told you, we're going to now impose all the regulations again because the new approach isn't working? Is that possible?
So the fact that they're not releasing any official data tells me that they're probably not likely to do that. It's really hard to walk that back, right? But my concern all along has been the expectation of China reopening, right? Because there's been a lot of people like, oh, it's going to be great. China's going to be back, baby, this sort of thing. But in every other country where we've seen the dialing back of restrictions, what has emerged? This one final hurrah, this N wave, if you will, of COVID cases. And that's exactly what we're seeing. So the question in my mind to focus in on is, when do we start to see that N wave pulling back? As we see that, I think we can have a lot more conviction in the China reopening story. But even now, though, there's other ripple effects that are emerging. There's word the Biden administration is examining perhaps limiting travelers from China. That probably means limiting people going to China as well. It may not be as smooth as some people are hoping. It probably means that if you're thinking it's the end is in middle of January, it might be late January, it might be early February. So to some extent, it's still a bit of an evolving story, one to watch. If we were to say, though, that, take a little longer term view, is the first quarter likely to be stronger than the last couple of quarters? Probably. Is the second quarter of 2023 likely to be even stronger? Yes. So that, I think, is how you have to kind of gear your thinking as you're starting to wade into some of these areas and these names.
Yeah, of course, to that point about potential travel restrictions, We've already seen some countries like Japan the last few days say, okay, well, if you're going to travel back and forth, you need to at least, or if you're traveling from China to Japan, for instance, you need to show evidence of a negative COVID test. That could be the sort of middle ground that a lot of countries adapt and or adopt rather, and we'll see what the U.S. does in turn. To the point about Tesla, because it's not unrelated from what we were just talking about, shares of that company popping a bit earlier this morning on a new analyst note, but the stock's still on pace to round out its worst month, its worst quarter, and if I'm not mistaken, its worst year on record. Well, certainly its worst year on record. This was kind of like the punchline of the world of business Twitter yesterday. What are you anticipating for the stock into the next year?
So I've always been a little skeptical on the Tesla front, and I know it has its some folks love it, some folks love to hate it. I've always kind of scratched my head to understand the valuation that it gets, and as a student of someone who watches various industries evolve, we know it's very simple that there's going to be a lot more competition coming in, and we're seeing that in the U.S., we're seeing that in Europe, we're seeing that certainly in China, where there's a whole number of pure play EV companies. We're seeing those Chinese companies ship record EVs to Europe in the month of November. So the landscape is really getting far more challenging, I think, for Tesla, right? There's a lot more players. There's a lot of pressure to move EV price points down. So I think that's just going to be a big challenge for them. At the same time, not to be flip about this, but you have to wonder, like, well, what company is Elon Musk focusing on today? Is it Twitter, right? Is it SpaceX? Is it the Boring Company? Or it's Tesla. So I think until we have a better sense of where this iconic CEO is really focusing his time, it's going to be a tough sell in my book to get a lot of people back on board for Tesla, especially if we see a slower economic environment.
Yeah, absolutely. Okay, let's pivot now and head to the skies. Southwest continues to extend declines on further cancellations. Is it cause for concern? I'm sure the answer is yes, but talk to me about how concerning this is. What a mess.
It is a mess, especially as the news is reporting that there are memos out that saying internally they were very concerned about Winter Storm Elliott. So it really begs the question, and this might be somewhat simplistic, but what were they thinking? What were they thinking? I don't really understand what they did, why they waited so long to make the moves that they did. Having said that, though, are other airlines struggling with this? Yes, some not as much. So it really calls again back into question, what was the management thinking? And I wonder if there's going to be some heads that roll as a result.
Yes, yeah, absolutely. I was just taking a look to see how the stock has performed year to date. I think it's down about 24%. Some people might actually be surprised it's not even a little bit more than that. Yeah, 24.2 year to date. The 5-day, of course, now it's down 9%. A huge fall there in the last 48 hours or so. We will continue to follow the Southwest debacle or story, however you want to refer to it there. Chris, while we still have you, Wall Street bankers bracing for big cuts to their yearly bonuses. What does this say about the current state of the economy, and what do you think is important to know?
Well, if we think back over the last several months, have we seen any major IPOs? No. Have we seen some M&A deals? Yeah. Trading volumes have been a little wonky, So what are these banks doing, right? They're right-sizing their businesses. We've heard previously about layoffs, from Morgan Stanley and others. So it's no big surprise that this is happening. I just see it part and parcel of, hey, the outlook is probably not going to pick up, because if it was, these bonuses wouldn't be getting, cut so drastically. What'll be interesting to see as we move into, January, February is movement from investment bank to investment bank. Typically, when times like these happen, employees are unhappy with their bonuses. They can get poached. Sometimes, one investment bank can grab a great franchise from another one. So that'll be something to watch. And as they do that, it might lay the seeds for where they might be seeking new opportunities in IPO or M&A deals or other transactions.
All right, time now to pivot to our rapid fire section. If you're game,
let's do it.
First up, is there a valuation metric investors should consider using even more so than in the last few years? Have priorities shifted here, Chris? What do you think?
They should be shifting. I kind of alluded to this earlier when we said, look, we don't necessarily know the direction of earnings, right? They're likely to be down, but how big, how far, how fast? The one thing that we can point to, the dividend yield. If you've got dividend paying companies, this is a wonderful metric to lean into, and one that I am using increasingly, not only in the last few months, but as we head into 2023.
All right, number 2, would you prefer a high dividend yield or a company with a history of increasing its dividend?
So high dividend yields are a little tricky here, JD. Sometimes if they're too high, it's actually a warning sign that there might be something up with the company's ability to pay that dividend. So I tend to shy away from very high dividend yielding stocks. Remember, I said Verizon, great business, very inelastic business model, has around 7%. You go much higher than that, it can be, again, a warning sign. I really love, though, again, those dividend dynamo companies, again, companies that increase their dividend every year, no matter what. Think of the type of business you need to have. Think of the quality of management that you need to have to be able to do this year in, year out. Some companies, as long as 40, 50 years. That is the quality company you want to own, especially as we move into a potential recession.
Absolutely. Okay, third, what retailer are you eyeing to take advantage of for post-holiday sales?
Now, this is a two-pronged question, two-pronged answer for me, sorry. So on a personal note, I continue to look at Vuori, which is a great athletic wear company. They're private, and that's on a personal note of buying. But I will say, also as a consumer, I spent money not at Costco yesterday, not at Walmart yesterday, but at Target online. Because as we talked about, they debuted a new set of deals up to 50% off on a lot of things. And I think they could be clearing out some inventory faster than people might think with this sale. Something to watch.
Okay, my friend, we got about a minute left. Is there anything top of mind for you that I did not? Wait, do I have another rapid fire question? No, that's it. Anything else that we did not specifically address? I want to give you the opportunity to say, JD, I was really hoping to talk about this topic. You failed in your hosting duties to ask me about it. I want to stress it. Anything else top of mind for you? Because, I don't have a good track record of doing these sorts of things.
No, I don't.
Anything else that you want to stress for the day?
No, I don't think so. The one thing I would say is, I know a lot of folks, there's a lot of chatter about the Santa Claus rally. Maybe it happens, maybe it doesn't. But as we get ready to start 2023, there's a lot of things that we're going to have to deal with. We talked about a number of them thus far. Just be prepared, be patient, and do your homework.
Be prepared, be patient, and do your homework.
Do your homework.
That's the great Chris Versace, or as we like to call him around here, the dividend dynamo, which, whether or not you want it, is now going to be your new nickname because it just works. The moment you said it, by the way, I wrote it down. I couldn't help but write it down. And
Excellent.
We're going to have some fun with that tomorrow. Chris, have a great day. We get to do this again tomorrow, man. I'm looking forward to it. Enjoy your Wednesday. It's Wednesday, right? Enjoy your Wednesday.
You as well. See you tomorrow.
All right, brother. We'll see you tomorrow. All right, folks, that is going to do it for the Market Open here from the floor of the New York Stock Exchange. Stick with TheStreet for more on these and all of the major market stories that matter to you, and we will see you tomorrow.